IMF has cut 2025 growth forecast for major Asian economies and warns of global slowdown on trade worries. However, global brokerages have maintained their bullish stance on India. What's the rationale behind the same? Let's find out with Ashesha, who is joining with details.
IMF has warned of a tariff-led global slowdown because of which they've lowered their GDP estimates for India. We'll talk about that in just a bit, but first up, let's focus on what global brokerage houses are making of India's growth story. First up, Jefferies in its latest Greed and Fear report has gone ahead and increased its weightage on India by 1 percentage point. Remember, this is the second hike that they've done in the last 10 days alone, and their recommended weightage on India now stands at 21% versus MSCI Asia Pacific X Japan weightage at 18.7%. So they are clearly overweight when it comes to India and Indian equity market. In fact, they've also given various reasons where they say that they continue to remain very bullish. As far as Morgan Stanley is concerned, they've gone ahead and actually lowered their estimate on Sensex from 93,000 earlier. They've lowered their Sensex target to 82,000. In fact, they've also lowered their growth estimates and GDP estimates going forward. FY26 and 27 growth and earnings estimates have been lowered. They've also added that slower recovery in FY27 could come in at 6.3% versus the steady outlook that they had guided for earlier, and they've lowered their FY26 GDP growth estimates by 40 basis points to 6.1%. So yes, Jefferies is bullish when it comes to India, but Morgan Stanley is clearly not, and they've gone ahead and lowered their Sensex target as well on account of lower growth estimates that they are penciling in for FY26 and 27. Meanwhile, let's talk about IMF, which came out with its latest economic data for the world, and for India in particular, they believe India has been resilient, but despite that, they've lowered their growth estimate for India for the full year 2025 from 6.5% earlier. It has now been revised downwards to 6.2%. Although they believe India has been resilient as compared to other economies of the world, tariff-led higher uncertainty could continue to prevail, but consumption-led outlook continues to remain very stable when it comes to India. So that's the outlook that has come in from IMF. Moving on to Nomura's estimates then, they've given a target of 24,970 on the Nifty by March 2026. But Nomura also says that if the valuations were to prevail in that 17 to 20 times mark, remember Nifty valuations currently stand at about 19 times, then Nifty return could stand anywhere between negative 9% to positive 7%. So that's the estimate when it comes to Nifty from Nomura. They say India is better placed to gain from supply relocation, and they also perhaps believe that risk premium continues to trade at reasonable levels, and markets are resilient with the risk premium continue to remain in check. So yes, for now brokerage houses are divided when it comes to outlook on India, but IMF has for now lowered its growth estimates when it comes to India for the full calendar year.
Apart from brokerage houses, we also spoke to a host of experts to find out whether or not the target given by IMF of 6.2% matter to India. We spoke to Garima Kapoor from Elara Capital, who believes that 6.2% GDP growth estimate for India is realistic. Let's listen to understand what is her rationale.
In India's case, the 6.2% that IMF has set out, I would say is fairly realistic, although it is 30 basis point below what RBI as well as what the ministry had put out in terms of expectations. In my assessment, the estimates of both RBI and the Ministry of Finance should come down, get revised downwards as we have more clarity on how the trade-related uncertainties pan out. But given everything else, and given that India's business cycle is turning, with both government and RBI turning pro-growth, the outlook for rate becoming more clear and with a more aggressive rate cut cycle, crude below 67, 68 at Brent, and dollar below 100, I think the tailwinds for Indian economy in terms of cyclical terms are far more than what they were 6 months ago. So I would still say everything else being equal, notwithstanding the correction in global economy that we anticipate, India should still grow at a handle of 6 to 6.2%, and the assessment is fairly realistic.